Hello, everyone, and welcome to another edition of the Forex Technical Market Update for July 23rd, 2015. Before I start, just some housekeeping notes. We will not have an update for tomorrow, July 24th, because I will be traveling tomorrow, and that will make it virtually impossible to bring to you the market update. So I must apologize in advance. I know I get a lot of feedback from these market updates folks are finding them very helpful, and I must apologize for not being able to do it tomorrow. I will be back on Monday to do our regular. We will return on Monday to do the regular market update. So that's just some housekeeping issues. Okay, the chart that we have in front of us is the chart of the British pound, and we have seen over the last week or so. Taking a look at the weekly chart, you see that the candlestick pattern so far in the British pound has been a doji, and we can see that from the daily charts because we are in this narrow range here on the daily chart. So markets are up, they are down, they're up, they are down. For example, this morning the market rallied up to the 156.70 before collapsing down back to the central pivot point near 156.03. And if there were any doubts about the usefulness of pivot points, we see that market just traded. We got a rejection near this 56 region, and the market collapsed over 600 pips. Okay, so that's what's happening in the British pound. I would still be on the buy side of this market because the market looks more bullish than bearish. What will change that outlook is if we get a close below 152. These lows here near 152, that would be fairly bearish. And if you look closely, we could draw a trend line here. And that market will first have to breach this trend line and then breach the 152 low. So this reverse head and shoulders bottom is still in effect with the British pound. Taking a look at the euro this morning, the euro is up on the morning. We see some follow through buying after the market bounced from this 108 level, and we could definitely see a rally in the euro from here because, as I said, the market is bouncing near this 618 retracement level from the move to the upside. The initial move to the upside. So we could see the market attempt to challenge this 114 area, but the market would have to first trade above this trend line here, this breakdown of support line here that crosses today at 112. Taking a look at the Australian dollar, we see that the market is like the British pound in no man's land. And if you look at this week, we see that the market is just slightly up on the week. Very narrow ranges here in the Australian dollar. One day it's up, one day it's down, but with a slight bias to the downside because we see that the market has been channeling kind of to the downside on Australian dollar. So there's a slight bias to the downside, as you would expect in a massive downtrend. Okay, the Japanese yen, again, tight ranges, and we see that the market is attempting to close below this doji that was made yesterday and close below the 123.50 region. I think the Japanese yen is getting cues from the stock market because we're at a critical point in the stock market. And let me just bring up the chart of the S&P 500. We see that we got a rejection from this channel top. The market the market was in an uptrend, or is in an uptrend, and the market challenged this top here, and we see a evening star candlestick pattern, and the market is falling from that level here that we see. And normally, sometimes the Japanese yen takes cues from the stock market, and when we see a stock market declining, we could see a rally in yen or a decline in USD Japanese yen. So it's something to keep in mind. Now, this correlation does not always hold and bear fruit. So it's not 100% certainty. It's just an observation that we have seen over the last couple of years, and especially in times of financial crisis. In times of financial crisis, you would normally find the Japanese yen doing very well, and the Japanese yen increasing against most of the major currency pairs in financial crisis. Okay, taking a look at the Canadian dollar, the Canadian dollar is up versus the US dollar on the day after attempting. Remember, we said that the market is challenging this high. In the actual high that was made is 130.64. The high that was made in the year 2015 is 130.53. So to just repeat that, the high that was made, this is a monthly chart of the Canadian dollar versus the USD. And in 2009, the market spiked up to a high of 130.64. And some 6 years later, we see that the market declined and is coming back up to test this region. And that's why we're seeing such strong resistance at this region with the USD Canadian dollar. And now that does not mean the resistance will be broken. It does not mean that the market must decline from here, but it just means that expect a resistance in this region, and that is exactly what's happening with the USD versus the Canadian dollar. Okay, so if you take a look at gold has recovered slightly, and this is not uncommon when we have a huge breakdown. Sometimes the market will break down, trigger a lot of stops, settle down, may recover slightly, and then head back to the downside. So this is not very uncommon when we have a break. It's not all the time the market will just break and continue going down and down and down. That does this break, settle down, and then head back down happens quite a lot, and actually happens more often than not. So that's something to keep in mind in the gold market. Okay, so if you would like to have these signals sent to your trading account automatically, you can click on the link below this video. We're at a point where the markets are in tight ranges, and normally when the market breaks from these ranges, you will see some considerable gains. So click on the link below to get the signals, and have a good day. I'll see you again on Monday.